All right, up next is account classification. Now, what we're doing here is we're expanding on the basic definitions that were introduced with the accounting equation, like assets, liabilities, and shareholder equity. So we're expanding on that in order to add a lot of extra detail here that's necessary detail because, as you'll see momentarily here, first we're going to tackle assets because assets are pretty complicated. So instead of looking at them as just being something that you can simply, anything owned, tangible or intangible, we're going to add another facet to it, another dimension here. We're going to add the concept of future utility. Now, what we mean by this is that means that the corporation can get something, out of the asset in the future. The idea we're trying to emphasize here is that simply owning an asset isn't enough. Like, you own it, that's great, but can you get something out of it? So if you have assets that are no longer in service, so you got some old defunct computers hanging around and also hanging around on the books, they shouldn't be there because, again, you're not getting any future utility out of them. So we consider these to be obsolete. So the concept of obsolescence is introduced into assets. In other words, we want companies to take a hard look at what they own and determine what, if any, part of that is in effect worthless with respect to the future. And also, this definition affords us the possibility of being able to keep depreciable assets, which are sometimes called fixed or plant assets. So these can remain on the books even though they have a null book value. Now, the idea here is that you've written them down to zero, but you're still using them, right? You're still abiding this idea here of future utility. You're getting something out of them still. So how do we demonstrate ownership of an otherwise zero cost or apparently zero cost asset on the books? And the answer to how we do that exactly will be addressed in the video and portion of my handout that talks about adjusting entries. So you'll see how that comes into play there. Now, assets are so complicated, we're going to give them 4 categories. This is the only thing that you'll see that has this many categories. So our 4 basic categories we'll look at in a moment. Now, the first category here is going to have a brief future utility, and meaning it's going to be used, sold, or collected within a year. As a rule, all the others are going to be considered to be greater than a year, so with a longer life. That's the next slide here. So our first category, the one I was just discussing, is called current assets. That's why they call them current, meaning they're basically only good for the current period, the current year. And you'll notice all of these have what in common? Well, they all tend to be, again, either used up, sold, or collected within that time frame. So obviously you're going to be using up your cash rapidly. I mean, nobody keeps their cash in a business. Accounts receivable, the typical collection period is 30 days or less. So that's obviously going to be collected in less than a year. And I would hope that you're selling your inventory in less than a year. That's a bad business paradigm to go with if you take years and years to sell your inventory. And again, all inventory means is it's goods held for resale. The nature of supplies is that they are being constantly used up, so we consider them to be current in nature because of that. And we're going to add a new account for you called notes receivable, which is like accounts receivable in essence that, okay, somebody owes the company money, but in this case, it's much more formal because it's going to be signed by the maker of the note. That's the key thing here. It has to be signed by somebody who has the ability to sign. In other words, if it's for a person, that would be that person's signature. If it was another company, it would be an agent of the company that has has been designated the ability to be able to sign on such a document. And again, why is it like maybe better in essence than account receivables? Well, because accounts receivable, you may not have much of a formal, documentation trail on your hands there. You might just have a more informal agreement with somebody. Oh, I provided a service for you, I sold goods to you, and here you have this much time to pay. Maybe they've signed nothing in that case, but in the case of a note, you have a signature, so you can go into court and you can say, hey, Your Honor, I have this piece of paper in my possession, and this is proof that they never paid, because normally as soon as they pay, you would surrender the note and they would just tear it up because it's proof of the amount that they owe. So that's why we refer to something like that, like a note receivable that you have in your possession. Refer to that, just throw a little legalese at you here. We refer to that as prima facie evidence, which means the evidence proves your case on its face. That's just sort of the way to disentangle the Latin there. It means it's airtight. The fact that you own that still means that chances are virtually 100% that they still owe you that money. Because again, if it surrendered it, they would have destroyed it. You wouldn't have ownership of it anymore. And then the last category for our current assets here is just generically called prepaid expenses, which is just like it sounds. These are advanced payments that you expect. So the expectation here is that they will eventually be expenses. So two of these you might see in practice in the book and in your homework here is prepaid rent and prepaid insurance. I'm going to focus on the prepaid insurance example first and just sort of flesh out the idea here. Again, in other words, these are things that are booked as an asset now. You know that when something happens, and usually that something that happens is what? Passage of time. It's that simple. Time passes, and now it goes from being an asset to an expense. That's your expectation. That's why we call them prepaid expenses. So I'm going to draw on the top here to the best of my ability. So let's say you make a $3,000 payment. Hey, that almost looks like real zeros. All right. This is going to be on October 1st of whatever year. So you make a payment of $3,000 on that day for 3 months of insurance. So that's going to be insurance at the rate of what, $1,000 a month for the next 3 months. So on that day, when you make that payment, the entire $3,000 is considered to still be an asset. Why? Because you still have what? The ability to derive future utility out of it, right? You still have that future utility. You haven't technically been insured yet. Insurance doesn't happen until what happens? Until time passes. And during that passage of time, you have the right to make a claim. So whether you make a claim or not doesn't matter. It will expire gradually as time goes on. So in other words, we flash to the end of October. So there we are in Halloween, 10/31. Now on that day, month of October is gone. How much of that $3,000 is still going to be considered an asset? So just $2,000 now. So it's reduced to $2,000. Almost a dollar sign, but more of a something. That's pretty eclectic. Anyway, so only $2,000 of it's still an asset. So what happened to the other $1,000? The other $1,000 is now insurance expense. That's what you expected to happen. Right. So that means, again, that would be the balance of that account on the beginning of November. So $2,000 still. So we flash to the end of November. So now we're on 11/30. And then now what is the asset balance of that prepaid insurance? Well, now it's only going to be $1,000. Oop, that got out of control. And so did that one. All right, so but it's $1,000, a lumpy $1,000, but it's still $1,000. So it's $1,000. That's all it's worth now, meaning you've expensed another $1,000 as insurance expense. And of course, that's still going to be the balance in the account on the beginning of December. So we go to the end of December. So we go 12/31. And now how much of it's still an asset? And that would be a big zero. In other words, the last $1,000 would be expensed. So in other words, this is the pattern you expected to observe, that your $3,000 would diminish incrementally at the end of each month until there was nothing left in the account at the end of 3 months. Now, you could think, well, why don't we just write the whole thing off in, at the point where we paid the money? And the answer is, again, because it's not yet truly an expense. And we have to wait. We have to wait till time passes before we can definitively say that. That's important. That's because, again, a lot of companies would probably like to buy something, and what would they like to do? Oh, immediately write it off. Why? Because there's a tax savings associated with that. But of course, what do? We make them write these things off gradually under these constraints so that it better reflects the economic reality of what they're dealing with. In other words, yeah, they still own these things. They still have some utility in the future, and we should therefore demonstrate them. Because again, under the idea that I'm pressing there, that like we'll just write everything off, technically companies would not have any assets then, would they? No. They would have nothing but just expenses. Every time they spend money on something, bam, expense. That's all there would be. So what we're demonstrating here is that that's not true in practice, nor do we want it to be true in practice, because it would actually be, distort the economic reality of what's happening. All right, so that's current assets. And then now just so you know, in terms of like normally how do we see these in financial statements, you would probably see investments, which is often called long-term investments. That's what we need there. And fixed assets would be next. I keep them in this order in my presentations and my handouts because you're usually not going to see a lot of investments at this stage of the class, so it's really just more common. Plus, you'll see the flow of the information makes it so that it's a little bit easier to talk about the fixed assets first. What do we mean by fixed assets? We mean durable assets, and this is important, used in the course of business. They have to be used in the business, and you'll see why in a moment. So examples should be no surprise here. Automobiles, trucks, earth movers, buildings, machinery, land. Anything that sounds like it's going to be around a long time and probably costs a lot of money will probably fit into the fixed asset category, because again, they're going to be around a lot longer than just 1 year. All of those that I just described, except for the land, we depreciate it, which simply means a systematic devaluation of what we paid for them. And in the case of, is there any way to diminish the value of land? And that is, yes, if you remove resources, you can deplete it. But that means you mined it or something. Like we're talking about a piece of land in which there's a building sitting on top of it. Now that's not going to be depleted. It's just, that would be a fixed amount of money and would just sit in your books at that amount, theoretically indefinitely, until you disposed of it. So it will not change. All right, so again, that's all there is for fixed assets. Some of these categories go kind of fast. Now investments, third category, can normally be shown second on your books because there's a concept behind that there that will be described in another video. So examples here is the one I was just describing, which is long-term investments in stock, meaning the corporation intends to hold the stock indefinitely. That's the theory behind it. Now, what if you buy stock with the intent of selling it, as you feel like? Well, then that would be in the current asset section then, and we would call that short-term. I'll just do abbreviations here. That would be a short-term investment. So if you see the account short-term investments, that would be in the current asset section, meaning the intent here is to sell those shares whenever you feel like. But if the idea is we plan on holding it virtually forever, then it goes in the investment/long-term investment section. What else could be in here? Fixed assets not used in the course of the business. So if you buy a building and land and don't use it in the business, you have to put it here, and it can't be depreciated. That's the big thing here. It can't be depreciated. Now, of course, this is an easy workaround. A lot of businesses will buy a building and land, put one office in there. Now they can say, hey, we're using it in the business, and they get to depreciate it. So it's a pretty easy workaround in practice. And then lastly, we have accounts and notes receivable due in greater than 1 year. This is uncommon for what you'll see in the class, but keep in mind, like long-term notes receivable, like that's basically what any business that does long-term loans, that's what they have. They might have a lot of them on the books, and they will have them categorize that as investments. So in other words, if you have, like if you're lending out money for mortgages, bank, a lending institution, that's really what they have. They have a note receivable from you, a long-term note that could go on, 20, 25, 30 years or whatnot, whatever the period in time in question is. So obviously that would fit into the category of a long-term investment from their standpoint, because it's something that's not going to be paid off for a long time. In this case, it will be paid off incrementally over a long period of time. So that's another whole, bag of mystery to uncover in some other context here. I won't go too much, and won't go too deep into the weeds, as they say, with that. So that this indicates something that you expect to get paid in greater than 1 year. Lastly, intangibles. All right, so those first three we'll tackle because I in passing mentioned them, or at least a couple of them in another video, in another context. So in this case, patents, copyrights, and trademarks. Again, what do you own here? You own a piece of paper indicating rights of ownership. In other words, so that you can sue somebody in a court of law. That's really all you own. So that's why you consider them intangible, because ownership is limited to simply that. Now, what about that one that I haven't talked about yet, this mysterious sounding one, goodwill? Because normally when people think about goodwill, they think of it in terms of like, attitude toward your company, right? And trying to create an air of goodwill toward our company. In this case, we're talking about something that's a little bit more concrete. In this case, goodwill is really just, in the accounting sense, an implied asset. In other words, what we have here on our hands is a situation where the whole, meaning the whole company, is greater than the sum of its parts. So for example, let's say you have a company that on paper is worth $1 billion, right? That's what it looks like it's worth on paper. And let's say another company comes in and says, we're going to buy that whole company out right now, 100% of it, and they're willing to pay $1.5 billion. Again, the discrepancy here on our hands here is we have 0.5 billion or 500 million difference between those two. So why did this company pay this much for something that's only worth that much on paper? And the answer is there's something about it that you can't quite put your finger on, or maybe you can. In some cases, it's not as difficult as it seems. In other words, they looked at that and said, we're willing to pay that extra $500 million because this company is really worth more than it apparently seems. Now, what would be the thing that would compel somebody to do that? Why would you pay that extra money? And that answer is because this is the usual rundown. There's something about the company's, in general, like its name brand is so recognizable that you'd be willing to pay beyond that because you know that you're going to just make money hand over fist on it, right? It's just, it doesn't matter that apparently it's only worth this much. You're going to make way more than that. So it's basically you're betting that you will do so much better than you can imagine because of this name recognition, or maybe a great customer base, or a little bit of both. Those are the two main ones you hear. So in practice, it really is going to act as a plug, because when you think about it, the company did what? They doled out $1.5 billion in cash to get assets, net assets in this case, net of any liabilities, equal to $1 billion. And so how do we describe that difference? Well, we say, I guess we have an increase of $0.5 billion in goodwill. So that's all, just to make it all balance out. I mean, that's really the bottom line here. It's just to make everything equal. And you'll see as we go on in the class that accounting relies on plugs a lot more than you might think. And coming in, cold and not having any background, you think, well, everything's just very concrete. No, sometimes it's not that concrete. Sometimes we use estimates. Sometimes we have to plug things just to make things balance out, such as you see here. All right, that concludes the first half of the material dealing with account classification, because it's kind of complicated. So again, the next video should be a lot shorter, and we'll continue with how do we handle liabilities and what are we going to do to our owner's equity accounts. So see you on that one.